Time for another market review where we go over the markets and see whether a crash is coming. And of course, to help us out, we got macro ops research. So let's start with a quote. A trick to get a sense of the overall level of bullishness is to ask who the burden of proof is on. If you pitch an idea, do other investors take your side immediately, or do they require evidence that your view is correct? If the answer is the latter, your idea is probably off consensus. And this is from Michael Fritzl, long-term front running. And we've talked about this a lot over the years, that normally the right decision in the market is not the popular one. You're usually going against the crowd, and that's how you make money. Now, of course, you guys know I'm a momentum trader, so how does that fit into momentum trading? Because you literally do want to go with the crowd. Well, for me, it usually comes down to the news cycle, or what everyone is saying versus what my system is saying. So recently, my system or strategy, whatever you want to call it, it had me going long the market. But at the same time as I was supposed to buy in, the news was coming out about Trump and the CCPV, and everyone was worried about, is he going to survive? Now, was that a big deal? Yeah, it kind of was, and it still is, but at the same time, there's always going to be some news story coming out. So more than fighting with the consensus view, you end up fighting with yourself. Like, hey, should I actually take this trade when my strategy is telling me to? And the answer always is yes. You got to follow your strategy. And when this quote says, when you pitch an idea, do investors immediately agree with you or ask for proof? It's the same kind of thing that happens when you're trying to follow your own system or strategy. The times where it's hardest to get in, when you're fighting against yourself because you really don't want to, because you're scared or whatever, you think the news is correct. Those are the times that you have to overcome it, get in, do what the strategy is saying, and you usually get rewarded the best. I don't know why it works out like that, but it does. And the worst is when you don't follow your strategy. That's when you get scared and you sit out and all of a sudden you miss the move. So even with the strategy that I use that is very easy and very effective, it still comes down to self-control. How much can I control myself and my mind? Because it does get tough out here, especially when we're overloaded with information. And by the way, if you're interested in the strategy that I'm talking about, that I use and a bunch of our Fallible members use, then check out this free training. We go over the whole thing in detail. There's a link in this video and down below in the description and comments. But this quote really reminded me of how tough it can be sometimes when you are going off consensus, even though it might be against yourself. But being able to control yourself is also why I've been able to reap the gains of this strategy, which is up almost 60% this year. It can be tough sometimes, but it's worth it. So in Alex's latest report, he said that this graphic is one of the most concerning he's come across in recent memory. Politico writes that among Americans who identify as Democrat or Republican, 1 in 3 now believe that violence could be justified to advance their party's political goals. And that's a huge increase over the last 3 years. In September, 44% of Republicans and 41% of Democrats said there would be at least a little justification for violence if the other party's nominee wins the election. And you can see that in this graph right here, going back from 2017, and this is the amount of Democrats and Republicans that agree that violence could be used. It's been jumping every year. And this is both sides, doesn't matter the party. It just feels like society in general is becoming less civil. And this is a good quote from Eric Hoffer from The True Believer. Our frustration is greater when we have much and want more than when we have nothing and want some. We are less dissatisfied when we lack many things than when we seem to lack but one thing. Basically, we're all spoiled. And I'm sure you felt yourself this year, things getting way more heated than they used to be when it comes to politics. Now, I generally don't talk politics in general, but now I'm avoiding it even more because people just can't control themselves. There's no room for discussion anymore. And if you don't agree with someone nowadays, it's not just that you don't agree and that's okay. It's more like, hey, you don't agree with me, so you're literally evil. It's that intense. And these numbers right here kind of prove that mentality. Because yeah, if the other person is evil, what's wrong with a little violence? Because we're all self-righteous heroes, right? On the inside, no possible way we could be wrong about anything. But it's really getting nuts. I'm seeing like 40-year friendships deteriorating over this. And I know this stuff is important, but being able to talk is important too. And Alex wrote another article once called The Label Stupidity Loop, or I think it was called that. But basically what he said in that article is the more you identify yourself with a certain label, the more rigid your mind becomes. So it applies to a lot of different areas, but in this case, if we talk politics, if you truly want to have an open mind and look at everything objectively and make the best decision, then you don't really want to be labeling yourself a Republican or a Democrat. Because then all of a sudden what happens is that you label yourself as part of this group, and then all your thinking ends up being in line with the group. You stop thinking for yourself. So if you're presented with an issue, you don't say, what do I think about this? You start thinking, what does my party think about this? And then again, all it does is close off people's minds more and more. And this happens with more than just politics, like I was saying, any label. So in investing, like for example, with macro ops and the strategy we use there, it's macro discretionary. So we're not only just macro traders. What we do is we put in value investing and momentum investing and we combine it all. And that makes for some pretty good returns. But what do you see some other investors do? For example, value guys, who I always pick on, I don't know why, but they can't understand how valuations can keep getting higher and higher, and then they miss out out. They can't understand why anyone would buy stocks at certain levels. And the reason why is because they consider themselves and they label themselves value investors. So you could only think in value. But again, it's limiting. So really, if you want to keep your mind open, one of the best ways to do it is to not label yourself. You don't have to be a value investor or a Republican, a Democrat, or anything. Just be yourself and think for yourself. And hopefully if more people did that, there'd be less violence, which is just nuts. Victor Schvetz explains in his book, The Great Rupture, that this widening societal chasm is being driven by technological changes on the one side and our dangerous addiction to debt on the other. And he calls this dangerous coupling the Fujiwara impact, which is two hurricanes merging and reinforcing each other. And I could talk about these technological changes a lot, but what's interesting is that the more connected we got through technology, the more separated we got too, because everyone is in their own echo chambers on Twitter, Facebook, wherever you go. Because maybe before, when you had to talk to the person who was close to you, even if they had a different mindset, well, now you don't have to talk to anyone except people who agree with you. So you go into your little corner of the internet and you get more and more radicalized. This chart right here shows that 15% of US companies are now zombie companies, which goes back to our addiction to debt. And zombie companies are those where profits are less than the interest paid on their debts for the last 3 years. So they're not even making their debt payments. They're basically a failing company at that point. And that's just another symptom of the multi-decade debt binge, which goes back to those Dalio debt cycles, which is always interesting to remember, because if you look at his theory and how he looks at things, then you could see all of this was gonna happen. All this political divide and everything, which is also kind of annoying because, what are you supposed to do about it? It's like, are you stuck with this destiny of long-term debt cycles and chaos? Maybe. But while the above is disheartening, we need to disconnect that part of our psychology when analyzing the broader market, since market moves are off of liquidity and relative value, stocks versus bonds. And what do we know? Liquidity drives markets, right? That's the Druckenmiller saying. If the Fed is pumping, then stocks are going to go up. Same thing with relative values. If the Fed is pumping and keeping interest rates low, well, then bonds aren't going to be so attractive, right? And if people don't want bonds, then they're going to put their money in stocks because they need a return somewhere. And bonds aren't giving it. So those are the things we really need to look at. And the outlook for the short-term economic growth in the stock market itself remains quite bullish. So this chart right here shows that we're in for a massive inventory restocking cycle because we're hitting like record lows right now of inventory. The surge in US retail and housing demand has pushed inventories in these sectors to record lows. So manufacturing inventories are not yet in extreme, but will likely decline further once retailers and home builders ramp up their orders. So all of this is likely to create the biggest restocking cycle on record. We expect inventory rebuilding to add considerably to growth over the next 2 to 3 quarters, creating a long tailwind for manufacturing activity and global trade. Building is good for the economy. The Goldman Sachs Global Leading Current Activity Index has rebounded to its highest level since February 2018. So you got to remember that before COVID hit, the whole world, excluding the US, so the rest of the world, was coming out of a long and painful recession. So the excess has long been wrung out from the system. This, combined with the backdrop of record low rates, easy liquidity, and mounting fiscal stimulus, provide a very favorable backdrop for risk assets. And if you need more evidence of a sharp rebound in global growth, Korean exports, which is a strong leading indicator of global EPS growth, are at their highest year-over-year point since October of 2018. And the US new orders inventory ratio just hit a 10-year high. So again, more economic data pointing to things looking good. So the news keeps saying that we're in for another devastating second wave of COVID cases this winter, but the data actually looks pretty good. There's some level of herd immunity that looks to be establishing itself. So a chart from Bank of America, this one right here, is showing that European countries who were the most severely affected by COVID early this spring are largely being spared right now. So it's looking like, thankfully, there is some immunity. And also, the rising cases in the US can entirely be explained by more comprehensive testing. So the disease is not getting worse, but rather our testing is getting better. So both the test positivity rate, hospitalizations, and deaths continue to trend lower, actually. So it's looking much better. You can see that right here, 7-day COVID-19 test positivity rate going down. Now, in the hierarchy of markets, credit sits near the top, meaning you can look at the credit market first, and the credit traders are the smartest. So if something's going wrong there, you can expect it to hit the equity markets and stocks soon after. Credit leads equities, so it pays to pay attention to the commercial bond space. So Bank of America pointed out in a recent report that we've seen 18 billion in net upgrades over the past 2 weeks. And that's compared to 538 billion in downgrades in late March and early April. So that's a positive development in the credit markets, meaning equity markets should look good as well. So right now with our research at MacroOps, we're predicting a Biden Democrat sweep this year. And the reason is basic demographics and eligible voters. And I'll make another video about that soon, about that report that we made. And according to the betting markets, this isn't a contrarian take. Predicted is pricing in a Dem sweep. So you can see right here, the blue line is Biden. Most people are betting on him winning, as well as the Democrats taking the Senate. Another thing that's interesting is that bond volatility is at an all-time record low, which is strange strange because we're seeing rising political disunity, rebounding growth, improving COVID data, and high odds of a Dem sweep. So we should really see that volatility come back, especially if we get a CARES 2 deal done. There will likely be a sell-off in bonds, which will spike that volatility. The Nikkei 500 just hit an all-time high. This is Japanese stocks here. Finally, after how many lost decades? Also, we talked about this in a previous video, but Twitter finally broke out. And what we mentioned in that previous video was the daily active users were really growing, and that Twitter was in a huge cup and handle pattern on the monthly chart. So lots of basing action could mean a big move is coming, which looks like it started. So looking at the long-term charts, we could see that the September monthly candle on the S&P actually didn't close too terribly. You can see it has a long wick right here because buyers came in and bought the market up. And remember, we look at these monthly charts because it gives us a good idea of where prices are headed. So depending on how the monthly bar prints at the end of the month, we can see how interested buyers are in the market. And in this case, they fought off the bear. So buyers came in at the end of the month and bid the market up well above the August lows. So the path of least resistance remains strongly in favor of higher prices, which is why we're still bullish. No crash yet. And if we look at sentiment and positioning outside of a subset of retail buying large amounts of call options, positioning and sentiment have been reset and tilt bearish, which is good for markets. And that's how sentiment works, right? We want people to be bearish so that there's still money left to come into the market. If everyone was super bullish, then we'd be looking out below. Also, large asset managers, which we've mentioned before, remain grossly underweight risk assets, which means they have cash on the sidelines ready to buy into dips. They still got to put their money into the equities. That's good for us. It means the bull market will continue. Breadth strengthened last week and is close to giving buy signals. And breadth is just how many stocks are going up versus down. To see a good bull move, you want to see a lot of stocks moving together higher. And macro conditions are rebounding and liquidity is flush. So everything looks good for higher prices. And again, if you want to see how we're playing it with our systematic strategy, then make sure you check out this training. We explain all of it. There's a link in this video and down below in the description and comments. Definitely do that before this move takes off. It'll be worth it so you don't miss out. If you like this video, make sure you subscribe. We have more coming. Do that and I will see you in the next one. Stay fallible out there. Bye.